Happy Tuesday, everybody, and first day of July. We are officially halfway through one of the most turbulent years and definitely quarters in recent history. So, just to reflect a little bit, I'll share my screen on Q2 and what happened. Um, so believe it or not, back in April, we started off Q2 with the tariff announcements. Yes, that was only April, which triggered the S&P to plunge roughly 19%. We then whiplashed into a pause on that, just in time for rising tensions in the Middle East to bring us back into volatile waters, sprinkling in some AI competition, causing concern for Mag 7, and then crossing our fingers that shifting interest rates would maintain expectations. All that being said, seems like a lifetime ago, but in the short span of a quarter, the S&P 500 has rebounded and hit new all-time highs to erase April's sharp sell-off and close out June and Q2. So while this year so far and quarter has been a roller coaster, as we predicted, it has also been a year of resilience and rapid rebounds. That being said, hitting new highs, it usually does bring in the fear of missing out for retail investors. And that alone can cause a rally because they might not have as wonderful financial advisors as all of you. And other retail investors might be sitting there going, maybe I should have bought in too, and rush into the market, which causes a rally. However, it's also very normal for the markets to trade down a tad because others who bought in here are just waiting to get back to break even and then sell. So don't be surprised if we trade down just a tad. That's normal, that's healthy, that's fine. So what are we watching out for moving forward? Obviously, the president's 90-day of reciprocal tariff ends on July 8th. However, recent comments suggest that he's flexible on that date, and I'm sure that will be a moving target with negotiations, so we'll keep our eye on that. Additionally, last month's surprise attack by Israel on Iran also raised fears of surging oil prices and the risk of broader destabilizing global conflict, which sounds scary, I know, but historically, for the stock market, geopolitical unrest has had little impact on the US economy, but we're still obviously keeping a close eye on everything going on over there. So, a lot of people very recently have been asking us, why is the market doing so well given all of this unresolved uncertainty? And there are multiple factors to the market's resilience. And in the most concise bullet point format, I'll go through those real quickly. So, number one, the economy is expanding. Even with moderating growth, this still supports corporate earnings. Number two, interest rates have remained steady. Number three, inflation is still trending lower. Number four, the most severe tariffs have been postponed, and it looks like there are trade agreements and negotiations in the works. AI-driven momentum is really good for all of the tech darlings and new leaders in that space. And then investors are wanting to buy the dip, which is causing more dollars in equity markets, which is obviously a good thing for stocks. So in short, as we suspected and had mentioned previously and positioned portfolios accordingly, it does look like resilience is winning out over retreat. And that is what many of you are seeing reflected in your portfolios. As always, if you have questions specific to your situation, don't hesitate to reach out. Otherwise, I will wish everybody a happy 4th of July. Stay safe, make smart decisions, and we'll talk to you all next week.